Good afternoon, and thanks for joining us with respect to our webinar this afternoon focused on the Purdue CME Group Ag Economy Barometer. I'm Jim Minter, Professor of Ag Economics and Director of the Center for Commercial Agriculture here at Purdue. Joining me are my colleagues, David Widmar, who is a Senior Research Associate in the Center for Commercial Agriculture, and Michael Langemeyer, who is a Professor of Ag Economics and also the Associate Director of the Center for Commercial Agriculture. And we're here today to talk a little bit about the Ag Economy Barometer's recent results and a little bit maybe of some of the history of the barometer. We just released the barometer here a couple of days ago, and the results have been very interesting. It's been interesting to track the barometer over time. And I put a chart up that shows the barometer going back to when we started collecting data in the fall of 2015. And of course, we survey 400 farmers nationwide with respect to a variety of things with respect to the ag economy. We use the responses to those questions to develop the barometer index itself. And the interesting thing, of course, is you look at the right-hand side of that chart, the barometer bottomed out last fall at about 92, and since then has increased rather substantially. Of course, the 116 was the November reading, and that was from just a week after the fall election. We continue to see an improvement in the barometer in December and January. Since then, the barometer has backed up some and softened a little bit. The last couple of months, they're at 134 and 124. The most recent reading here from April, a reading of 130. And I think as you look at the right-hand side of that chart, the interesting thing about that is that although we have seen some softening in the barometer readings these last several months relative to where we were in January, readings going back to last fall are the strongest readings we've had on the Ag Economy Barometer since we started collecting data in the fall of 2015. So people in the ag sector, producers in the ag sector are more optimistic about the economy, the ag economy, than they were prior to the election. And we're going to explore that in a little more detail and see if we can shed some light on that going forward.
And to back up just a little bit about the project real quickly, we're surveying 400 ag producers of corn, soybeans, wheat, cotton, beef cattle, dairy cattle, and hogs on a monthly basis by phone, about a 5-minute survey. And these are representative of producers from across the country with gross farm annual sales of more than $500,000. And so we've been doing this for the last 18 months. We've been sharing our results publicly for the last year. And so it's been a very exciting project to do and help tell the story of what's going on in rural America and in production agriculture specifically. One of the neat things that we can do with this barometer is we can also take this apart a little bit and start to understand what's driving sentiment. Is it more of the current conditions, or is it more future expectations? And that's what we've started to see really take place after, as Jim mentioned earlier, that those November results. We saw there in the kind of the bluish green line that index of future expectations, which is that forward-looking measure of producer sentiment, really took off post-election and peaked in January at 169. It moved a lot from 95 in October up to close to 170. Since then, it's backed up a little bit. It's still similar to the barometer at 132. It's it's higher than anything we saw throughout late 2015 and all of 2016. The other story here that's kind of underpinned sentiment in the last several months is the index of current conditions. This is producers' kind of current realities they're facing, and this has been trending upwards since August when we hit 80 points. And since August, we've seen that's when commodity prices really hit their low point. There's a lot of uncertainty among producers as to what their yields would actually be. But as we moved into harvest, and the commodity markets didn't collapse as many feared and worried about. And then we have since seen some improvements and upward trending in prices post-harvest. This has really kind of been this current conditions, is that producers' current reality, I guess, has improved quite a bit. And we've seen this when we think about what actual farm level yields are, county level yields, and commodity prices. So for a lot of producers, their revenue expectations from 2016 have improved since August 2016. And that's really kind of been underpinning sentiment, I think, a lot in the last few months.
Yeah, the jump occurred in the fall with respect to this change in longer run expectations. But your point, David, is one that I think is well taken. People have become a little more optimistic about the current situation in agriculture. And in fact, if you look at the last couple of months, as that future expectations index was starting to come down a little bit, the fact that we were getting a little more optimism about current conditions was actually helping provide some support to the overall barometer index value itself.
Yeah, and then more specifically, when we think about April 2017, when we last surveyed, it's 127. That's a new survey high. We previously were at 125 as a high back in December 2015. There's a nice post-harvest rally back in December 2015. So this kind of current condition sentiment measure has improved steadily for several months now, and that's really been a big contributor here.
Let's take a look at a specific question. And Michael, you've taken a look at this one.
This is related to what we were just talking about here with the index of current conditions. You know, even though there's only 11% that say that their farm operation is financially better off compared to a year ago, it's still quite a bit higher than it was even a few months ago, when it was back down to 3% last summer and 5% in November. I mean, 11% is still a small number, but it's quite a bit better than what we saw before the election. And so that's certainly a sign, and one of the signs that's very consistent with that increase in the index of current conditions. I think there's a couple things going on here. I think some people thought prices were going to fall a little bit more than they did. We had relatively strong yields, and one of the things we haven't talked about is the fact that we've cut some out of our cost of production. We've reduced our corn cost of production, for example, about 50 cents last 2 to 3 years. That's helpful when you're starting to look at your current conditions. We have more to go, yes, to get closer to a break even, but we reduced our production costs, and so things look more optimistic today than they did, particularly when we started this survey 18 months ago.
Yeah, and if you look at the numbers again, just to reemphasize that, if you look at the numbers for the April survey, it's about twice as many people that were feeling that their operation was in better shape than it was just a few months ago, and that's significant, even though the total is a relatively small number. We asked a question about this with respect to the ag economy. David, you want to comment on that one?
Yeah, so this question's a little bit different. This one asks about expectations over the next 12 months. Do producers think there'll be widespread good times or bad times financially? And this is showing the share of respondents who reported good times. And as you can see here, there's a bit of a bump in the last several months. We spent most of 2016 with 20% or fewer producers expecting good times, thinking about the next year. We almost doubled that in January when we hit 41% who thought that good times would be more common in the next 12 months. But now we've since slowed that back a little bit, and we're at 28%, still much higher than we saw for anything throughout late 2015, most of 2016. And so this is what we've seen, is this improvement in sentiment. Is when producers think about the next 12 months, there's been an improvement in their outlook as they look forward. I guess one way to think about this is if there were 10 farmers in a room a year ago at this time, 2 of them would have been saying the ag economy will have some good times in the next year, and now it's closer to 3, and as high as 4 in recent months. So I think that's one of the underpinning shifts. The one thing to also point out here is that while sentiment has improved, these are still tough times in agriculture. We still have net farm income estimated to decline in 2017. There's still a lot of farms and ranches out there who are having tough times financially. And I think this question also kind of provides some context that while there's an improvement in sentiment, this is by no means a signal that these are good times in agriculture, with 70% of producers still thinking that they're not good times.
And that's a good point, David, because we're kind of emphasizing the change that's taken place and trying to explain the change we've observed in the barometer over the last few months, particularly since the November election. But as you look at the data, clearly a majority of people are expecting some very challenging times in production agriculture over the next 12 months, and as we're going to see in a minute, over the next 5 years as well. So there has been a shift, a significant shift since the fall. It has been to the plus side, but it doesn't make the entire picture for the overall ag economy look positive.
And it certainly doesn't translate into positive margins for crop producers, for example. We're still a ways away from that. And it also doesn't translate into disappearance of some of the liquidity issues that we're seeing out there. And so I think that's a couple things we have to keep in mind as we're looking at these numbers.
It's really a more optimistic outlook about a generally tough time in production agriculture is what we've observed here.
And it remains to be seen as to whether or not the readings that we saw last fall, in fact, turn out to be the bottom. If we continue to see these more positive readings relative to last fall throughout 2017, I mean, that's going to be very interesting to monitor and then see the implications with respect to decision making on the part of producers. We also look at some questions focused on crops versus livestock. And this one says, over the next 5 years, are widespread good times or bad times more likely in the crop sector and in the livestock sector? And as you look at the data, respondents to the survey pretty consistently, with really just 1 month of exception, have been a little more optimistic about good times in the livestock sector than they have been about the crop sector. But as you look at both of them relative to last fall, both of them are stronger or more positive than they were last fall. And the bump has been a little stronger in the livestock sector with respect to expectations. And I think as you think about that, there's really probably a couple of things going on there. From the livestock producer's perspective, the good times that crop agricultural experience from about 2007 up through about 2013 were pretty challenging times for almost the entire livestock sector, because they were facing very high livestock feed prices, particularly feed grain prices and soybean meal prices. That was creating a very challenging environment for livestock producers. Now we're on the flip side of that with significantly lower corn prices, significantly lower soybean and soybean meal prices, creating a more favorable environment for the livestock sector. And I think that's being reflected in some of the data that we're picking up. But again, we're noticing a strong improvement relative to where we were just a few months ago and actually most of 2016. So we ask a question about soybean and corn futures prices, and Michael, you want to comment on this one?
Yes, I think the key here is looking at the soybean prices. When we did this in January, there was a fairly high percent, 44%, thought that there was a chance that soybean prices, future prices, were going to see $10.50 per bushel. Notice that that's dropped to 23%, so a very large drop in terms of the percentage of those that think soybean futures are going to exceed $10.50 per bushel. Also on the downside, there's more pessimism on the downside. There's a considerably higher percent that think soybean futures could drop below $9 per bushel. And so this is consistent with the drop in soybean prices that we've seen across the future spectrum. And so that wasn't a real big surprise, but it's interesting to quantify how producers think about that. Also, not as big a drop as what we saw for soybeans is the fact that we have considerably less people that think corn's going to exceed $4.25 per bushel. That's also important. Because again, there's some people that have dropped their production costs enough that as it gets closer to $4, they're probably looking at some positive margins. So it looks like people don't think there's going to be quite as good a pricing opportunity in the April survey compared to January. I wonder what your thoughts are on that, Jim.
Well, to me, the big interesting point on this slide is what took place with soybeans, right?
Yes.
And of course, that's being driven partly by the big shift in acreage. Mm-hmm. Expectation for larger production here in 2017, leading to some lower prices. So a big shift in the environment there. But I think you make a good point with respect to what's taken place on the corn side. There's more optimism on the corn side than what we were expecting earlier in the year. And that's an important driver of profitability. So it's going to be very interesting to see how that shakes out as we head through the rest of the spring and into the summer. And as we were talking before the webinar today, with the weather conditions we're experiencing right now in much of the Corn Belt and parts of the Great Plains, there's a potential to see some impact on these markets going forward, and that could change some expectations as well over the next 30 or so days, right?
And circling back to Michael's comment about these price points that were selected, we looked at exceeding $4.25 for corn and exceeding $10.50 per bushel on soybeans. When you think about the crop budget implications, these are prices where these are futures prices that a lot of producers would get very near to break even, if not starting to be able to lock in a decent or a small profit margin. And so this is kind of the good side if we got to these levels. So we see fewer producers expecting those good high prices that get close to break even. On the other side of the coin, $3.50 per bushel in corn falling below that price point and $9 per soybeans, that's going to start to be a pretty difficult budget environment if we saw those prices for a prolonged period of time. So that's an important thing to keep in mind as well, the implications of these prices in the budgets.
Now let's take a look at some other questions, and we've asked some questions on an ongoing basis about machinery prices and people's expectations there. And I know that's an important thing for the industry. And we're starting to get enough data now that we're starting to get some hints as to whether or not this can turn out to be a little bit of a leading indicator. So let's take a look at some of those. So the first one is thinking about large farm investments. You want to talk about that one, David?
Yeah, so this is a question that we ask on a regular monthly basis, and it's asking about large farm investments such as a building or machinery. Generally speaking, is now a good time or a bad time to buy such an item? Thinking about these investments and how this sort of plays out in their farm and the general farm economy. And what we've seen is that in general, a small share of producers think it's a good time, but we've seen some variations over time. So in April is at 28%. We got as high as 32% back in January, saying now is a good time. But what's really important is if we look back to, say, October 2016, we're at 22%. We're saying it's a good time. So again, this is another one of these areas where we've seen changes. These are relatively small changes in terms of the entire survey, but they're pretty significant when we think about 2 out of 10 producers saying now is a good time to go out and buy a new barn or a new facility or a new piece of machinery, now to 3 out of 10 producers thinking that it's a good time. So going from this 22% to 28 or 30% is a pretty big improvement.
It is indeed. In fact, when you have some conversations with some people in the industry, it suggests that they have seen a more positive operating environment this past winter compared to a year ago. That's not necessarily being reflected in sales of brand new equipment, but it is perhaps being reflected in the sense of maybe better movement of used equipment, right? Michael, we took a look at some prices. So we have a question. We asked people to rate machinery prices as either low or high or about the same, and we've just got one of those on the chart here.
What's not on this chart is the share of respondents that rate used farm machinery as too high. That's been right around 50 to 52% as long as we've been asking this question. So there's about 50% think that used farm machinery price is too high. Quite frankly, guys, there's probably going to be a certain percent that think prices are too high regardless of the environment. But that's been very steady at about 50-52%. Rather than showing that, we decided to show the percentage of respondents that think prices are too low. And there's 2 ways to think about this question, and David and Jim jump in here after I go through these 2 things. One way is to think, well, maybe we've seen some continued price declines because of the tough times in agriculture, and that's how they're responding to this question. Another way to think about this question, this takes a little bit more thinking, is perhaps this is a sign that the people are a little more optimistic. And so they're thinking about maybe this is a time where I need to start thinking about either buying new machinery or used machinery, and it's reflected in this increase from 17% to 22% in April. And so I think there's 2 different things that could be going on here, and I'd be curious to know which of those 2 things you guys think is going on.
So Michael, to follow up on your last point, if you think of it that way, that movement from 17 a year ago to 22 today could be reflective of people looking at used machinery and thinking it's a good value.
Yes.
Right? Given their optimistic,
given their situation,
or perhaps a little more optimistic perspective on the ag environment or ag economy today versus a year ago.
And think about when you're buying machinery, you're not looking at what times are going to be like in the next year. Usually you're looking at 5 years, 7 years out. And so that's why I'm going into this, because machinery really is a more of an intermediate term purchase, something you're looking at kind of a long-term perspective when you're purchasing the machinery. And so this could be a sign of some longer-term optimism, and it's very consistent with some of the indices we talked about earlier.
David, I think you've looked at this a little bit with respect to used machinery values. We don't have a database of those, so we can't make really strong comparisons, but you've looked at that a little bit with respect to the farm press in particular.
Yeah, I think when you look across the farm press, all the different publications, there's been anecdotal evidence and some auction data to support that used farm machinery prices maybe in the last 3, 4, 5 months are a bit firmer than they were through last summer or last fall, and maybe a little firmer than last year. So this is saying it's hard to kind of understand exactly what producers were thinking about when they asked this question, because they were rating the prices of used farm machinery. But in general, right now, there's a sentiment out there that right now there's an increased number of producers saying that prices are low than what we saw, say, in April 2016. So from 17 to 22%, a change there. So Again, this is tracking kind of actual data. We see maybe some firming, but then producers are more likely to rate it as a low price in today's environment.
Yeah, so just to kind of reiterate, we don't really have enough data yet to confirm that this is a leading indicator, but what we suspect this might be, and we're going to be very interested in following this going forward, is to whether or not this actually is a leading indicator with respect to people being a little more optimistic, a little more willing to make a commitment with respect to purchases, and that's something we'll have to wait and see going forward. But as I look at that movement from 17 a year ago to 22 today, or on our most recent survey, that is the kind of change that I think could catch people's eye and perhaps could be indicative of just a little more positive operating environment for the farm machinery business.
Right, so you see this coupled with this boost in sentiment. So this boost in sentiment, and now kind of one of the action points that we're seeing from that is that there's a shift in perceptions on used farm machinery values, and definitely one of the measures that I'll be keeping an eye on in the coming summer and fall as well.
So we ask another one, do you think that used farm machinery prices will be higher, lower, or about the same 12 months from now? And again, we're picking up a little bit of optimism there. 24% of the people on the April survey said that they expect used farm machinery prices to actually strengthen over the course of the next 12 months. And only 16% said they expect to see it decline. So again, we need to collect some more data from a longer term perspective to confirm whether or not this is a leading indicator, but we suspect that this might be a leading indicator with respect to some change in behavior with respect to the willingness to make some large investments in the machinery sector. So we'll see how that shakes out. One of the questions, Michael, we ask is about what people expect to do with respect to growth rate. This isn't something we ask every month. In fact, we asked this, I think, a month ago, not on the most recent survey. But we asked them, what is a reasonable annual growth rate expectation they have for their farm over the next 5 years? And I thought the responses to this were fascinating.
Yes, they are. A lot of divergence in what people are going to do. But before I get into the details here, I just want to remind the audience that we survey people with gross sales over $500,000. That's very important to keep in mind. If we would survey some of the producers smaller than that, the results would be quite different here. We'd probably get a higher percent of no growth and a higher percent of exit and retire. And so that's very important to keep in mind when they're comparing this information to some of the information coming from USDA ERS, for example. But I find it fascinating here that only about a third, a little higher than a third, we're expecting no growth over the next 5 years. We obviously have some retirement always going on, but some pretty high percentages where we're thinking about growing 5% or over. And in fact, 2% said greater than 15% over the next 5 years. Those are some very large growth rates, particularly coupled with the fact that they were coming out of about 3-4 years of some pretty tough margins. And so even after 3-4 years of pretty tough margins, people think their situation is strong enough, or their expectations are positive enough. They're quite optimistic to think that they're going to grow this rapidly in the next 5 years. And so I think two things are really important here: the divergence between producers and the fact that we've got about 10% there that are thinking about growing in excess of 10%. I think those are two very important things coming out of this chart.
Yeah, and the other thing I think this chart is indicative that there's a significant portion of the industry that's pretty optimistic,
yes,
right, with respect to opportunities to grow and the value of continuing to grow in the ag sector. And I think one of the possibilities here is when we look at margins, whether it's in the crop sector or the livestock sector, we base those heavily on budgets that are done here at Purdue and in some cases at some other universities and USDA, and those are largely reflective of average cost situations. And yet we know from other research that there's a tremendous amount of variability in cost of production among producers. And so the bottom line is, if you've got an average number, some people are going to have below average production costs. So when we talk about margins being very tight, they are in general. However, for low-cost producers, even at current price levels, they're still operating in a positive environment. And I think when we look at the folks that are thinking about growing, those tend to be the low-cost producers that have a better opportunity to grow than obviously the average and higher cost producers.
Usually when I talk about benchmarking, I talk about the top quartile, and the reason I talk about the top quartile is if you're really going to be successfully grow over time, you're going to need to be in that top quartile or top third to have enough retained earnings to be able to buy machinery, buy land, rent additional ground. And I think that's very consistent with what we're seeing here. It's a little higher than the top quartile, but roughly a third of the producers are very optimistic and or have relatively low cost of production. Their liquidity is probably stronger than the other 75% of the producers, and so they're coming out of these tough times in pretty good shape to be able to grow very rapidly if they're optimistic, if prices improve.
This is a question that we ask going forward periodically, so it's something we'll be monitoring on an ongoing basis over the next several years.
And we haven't tied this to our question related to profitability in the next 5 years, but my guess it would be very consistent with that. Those that think that they're going to be quite profitable the next 5 years are probably the same people that are in this high growth
I would agree.
categories.
David, we also survey an ag thought leader group, and you might describe that group for us a little bit and then maybe share the results here.
Yeah, so in parallel to the producer survey, on a quarterly basis, we survey 100 agricultural thought leaders. These are ag lenders, ag retailers, ag manufacturers, ag consultants, even a few folks in higher education. And we asked them, again, on a quarterly basis, we survey them in April, questions that are very similar to the questions we ask producers. So instead of on your farm, it's on the farms that you are most familiar with. And so we do the same analysis as the producer survey, and we can also get a metric and a measure of sentiment from this group as they look and they think about the producers they work with. And so on the graph that we have here is we've been surveying this group back through November 2015, and we see a very similar trend emerge that we saw with the producer group. Going back to October 2016, I guess 3 bars from the right into the left, sentiment of this group reached a low point at 84, and then when we measured again in January, we saw this jump to 134, and then in April we saw this also trend higher. I wouldn't necessarily get too caught up in which bar in January and April is higher, but the trend is still the same. Sentiment that this group shared about the farm economy is much stronger than what they reported throughout all of 2015 and 2016. So this is kind of a confirmation of this general optimism that we see out there in the ag economy, in the production ag economy. Again, we've talked about this in the earlier seminar, but we've also seen this jump in sentiment thinking about broader in the economy. So there's an increase in sentiment measured from the University of Michigan's consumer survey of U.S. consumers, and several other measures out there have noticed this kind of early 2017, late 2016, post-election bump in sentiment. And this thought leader index is confirming the results that we saw when we surveyed producers. We also asked this thought leader group about their expectations for those same futures prices that we asked producers about, thinking about December 17 corn, November 17 soybeans, and how many thought we'd set new highs and new lows there. Very interestingly, the results, again, and the trends of the results were very similar, specifically with soybeans. A very large decrease in the share expecting soybeans to set those new highs exceeding $10.50 per bushel. Thinking about going from 40% in January down to 19% in April, more than half as many producers in April, or thought leaders in April, think that price rally is possible. Again, similar producers, increase in the share that expect that, or that think that new soybean lows falling below $9 per bushel on that November contract is possible. So I found this to be very interesting that both of these groups, the producers and the thought leaders, have sort of similar expectations. The magnitude varies a little bit, but the trends between the changes from January to April are very similar between these two groups.
Another thing that we've been talking about in past webinars is the fact that the ag thought leader tends to be a little bit more pessimistic with respect to prices, and even though we don't have the chart, it's been several slides since we covered the chart. Certainly, there's a much higher percent of the thought leaders expect corn to drop below 350. Futures price below 350, and a much larger percent of the thought leaders think soybeans are going to drop below $9. And so there is more pessimism. So we need to put that the fact that their index is improved in perspective here, that compared to the producer group, they are more pessimistic with regard to corn and soybean future prices.
So to me, the interesting thing is that we're seeing this increase in optimism despite the fact that they're more negative with respect to especially soybean prices than they were back in January. So, one of the comments we got early with respect to developing an ag economy barometer was that some people, I think, expected this to just parallel what was taken with respect to commodity price changes. And it's clear that there is more than commodity price changes that drive the sentiment and people's decision-making behavior.
Also, people think that this is going to track current profitability, and you've got to remember in this project we have current profitability or profitability compared to last year. We have profitability over the next year, and we have profitability over the next 5 years. And so this can be consistent. With the fact that they expect that their index is up, because they might have a lot of optimism 5 years out, and so they might be pretty pessimistic here with respect to corn and soybean prices, but they might be very optimistic 5 years out.
Yeah.
And so we always got to remember that we asked this profitability question in particular at 3 different times: the last year, going forward 1 year, and then going forward 5 years.
That's a good point. There's a difference there. And we also see that showing up. We didn't show it today, but when we ask people about farmland price expectations,
Yes.
right? And that's clearly a reflection, especially when we ask them about do they think farmland is a good investment. It's an indication of their long-run perspective with respect to the health of the ag economy and particularly the crop sector, for example. So I think we're going to wrap it up there, but we would encourage you to visit the website. I've got the website addresses up on the screen. The Center for Commercial Ag is purdue.edu/commercial ag, and then of course the Ag Barometer itself is purdue.edu/ag barometer. We have an extra report out there this month, and it is one that kind of reflects back, David, on the last 18 months with respect to what we've learned about the barometer. And so we're not going to elaborate on that extensively today, but we are going to do a little recording that we will post later on. And there is a nice story that kind of talks about some of the things we learned. And Michael was just elaborating on a little of that, but I'd encourage you to tap into that on the website when you have an opportunity, and we will have a video that discusses that probably pretty soon. So with that, thank you so much for joining us, and we'll look forward to visiting with you again.